Welcome everyone. In today's video, we're going to analyze Target stock, which is a stock that has been down 33% year to date. So this might be a huge opportunity to buy it. The 5-year chart also doesn't look good with the stock being down 19%. So let's start with the financials of this company. As you can see, the revenue has remained flat over the past 5 years, basically at around $100 billion. And as you're going to see, the profit is the same, with net income also, except for 2022, being around $4 billion and free cash flow being a little bit less, but around $3 billion with the exception of 2023. So this is a company that is in a very stagnant place. Taking a look at their margins, Target is a retailer, so obviously their margins are going to be low. Profit margin has been around 3% again over the past 5 years, and free cash flow margin has also been around 3%, again with the exception of 2023. If we look at what's expected for the future of the company, analysts are expecting basically very little growth over the next few years, and growth in EPS again very little. So a company that is not really expected to grow. If we take a look at some statistics of this company, as you can see, it's a $44 billion market cap and an enterprise value of $60.92 billion. This difference here is essentially the debt. If we take a look here at the balance sheet, they have $2 billion in cash and $19 billion in debt. The balance sheet in this case doesn't really bother me because they have a lot of leases. And then what's interesting about this company is obviously the valuation. The current PE is 10, the forward PE is 13, and the current price to free cash flow is 12. So it does seem quite cheap. They also pay a great dividend, which will attract a lot of investors. The current dividend yield is 4.67%. And it's a safe dividend because the payout ratio is 50% essentially. This means that it takes 50% of their net income to pay their dividends, because dividends come from profit. And now, in order to take a deeper look at the valuation, I'm going to use my Google Sheet. This is a discounted net income and free cash flow model, which tells you at what price you should buy a stock based on the assumptions about the future of the company that you put in. All of the calculations are done here, so you only need to move these numbers around. This is a 7-year analysis, and I did low, middle, and high assumptions. The intrinsic value, according to my assumptions, is between $55 per share and $163 per share. Now, this also means that if my low assumptions occur, you're going to make a 0% annual return on your money. If the middle one occur, 11%, and if the high occurs, 20.5%. Now, these returns take into account the dividend. So the 4.9% is included in these returns. Why? Because dividends come from the profit of the company, so you cannot double count them. In terms of my assumptions, we have seen that the revenue growth is very little for this company, so I went 0% on my low assumptions, 2% on the middle, and 4% on the high. The profit margin and free cash flow margin, we have seen that it has been between 3% over the past 5 years, so I did 2, 3, and 4. The P and price to free cash flow, this is not a company with a lot of growth, so I went with 14, 16, and 18. And the share outstanding change, they haven't really bought back a lot of shares or issued, so it remained at 0%. So, in conclusion, I believe Target could be a great investment, and I think you could beat the market over long periods of time. If you also like dividends, this might be a very good investment for you. I think it's cheap. However, with the current overvaluation of the stock market, I believe you can get this stock for cheaper. I hope you found this video valuable. Let me know what you think about Target stock in the comments, and I'll see you in the next one.